evening. You've got More Than Money. You've got Gene Dickinson, you've got Megan Smale. You have an entire team here at PBS to serve you for the next half an hour. And I can assure you, if you're just joining us, it goes very quickly. So don't wander off. Don't let yourself get distracted. A pad and a pencil, not a bad idea. You might want to take a note or two because maybe, just maybe, one of the questions we answer this evening will help you. That's the claim that we make. We are bold in making the claim that our show, based here on PBS 39, is the most relevant financial show on television today, bar none. I don't care what network you're talking about. I don't care what city you're talking about. We are the most relevant because of you. I would love to tell you it's because of my sheer brilliance, and some would agree. Well, but you can convince some people of anything. I think we figured that part out. Bottom line is, it's not us, it's you. You are asking questions that are very important to you, that are the most critical for you, for your family, for the people that you love, for your community, for your country. It's fantastic. And sharing those questions, sharing those concerns, those observations allows us to have impact, allows us to have that kind of a level of service that we're really making a difference. The emails that we get that are simply ones of thanks are so gratifying. Our audience is amazing, and with rare exception, so very kind and so very gracious, and we appreciate all that. But it really, the thanks belongs to you. You give us that opportunity. So if you are so inclined and you go through our show and you say, I've got a question I think would be fascinating, send those to me, gene@askmtm.com. We have an entire team, our MTM team, our More Than Money team, lots of advisors, lots of support so that we can answer all your questions back to you. Send them. One of our most recent ones from Southern California, apparently PBS SoCal picked up our show and some folks saw us out there. Fascinating. And since we're a national operation, coast to coast and border to border, we get to serve a lot of people. You're very, very kind. You allow us to do that. It means the world. Let's give you a demonstration of how it actually works. Megan, where do we start this evening?
Well, our first question, I hope you brought your Dr. Phil hat tonight. This one says, my partner and I have been together for 8 years. We are committed to one another, but neither of us wants to get married. We keep our finances separate and pay housing expenses based on a ratio of who makes more. When we moved in together and decided on this split, I made significantly more than my partner and paid a higher percentage. Over the past few years, I have gotten normal raises, and I thought she was too, as she had never said anything different. I got 2 big bonuses over the past few years and disclosed them both to her, and she has disclosed her bonuses to me. We used the same accountant, and last week the accountant accidentally sent my partner's tax return to me instead of her. I didn't realize it until I opened it up and the numbers didn't seem right. It took me a few minutes to realize I had the wrong tax return. I was shocked to see my partner's income has more than doubled since we decided on our split of the expenses. When I asked her about it, she first accused me of violating her privacy and then said that I never asked how much her raises were and she figured the split was fine still. We should have been paying 50-50 about a year after we moved in together, and she would be paying about 70-30 now. I feel really betrayed. She is now proposing a 50-50 split, but I don't think that is fair. Part of me wants her to reimburse me the money she should have been paying me the past few years, and part of me just wants her to pay 70-30. She says I'm being stingy and that I feel threatened because she makes more than me. I am rethinking our relationship not only because she lied by omission, but because she is accusing me of being misogynistic and is not seeing the ethical and moral failing on her part. She thinks I'm making too big a deal out of this and that we just need to move on. I don't feel like she's trustworthy. Part of me just wants to find a new place, move out, and have separate household expenses going forward, and part of me wants to just move out and break up. Am I overreacting, Gene?
No, you're not overreacting. Oh my goodness. I think you may actually be underreacting. your partner has made a number of choices over a very long period of time that basically has disrespected your entire relationship. This is not a financial question. Should it be 70-30? Should she pay you back? Should it have been 50-50? Those are all irrelevant. And the fact that she's now accusing you of being misogynistic, I don't know what massage has to do with this. I think it's a totally separate issue. In my head, that's very funny. You may find it or not. Her instantaneous, her knee-jerk reaction of, you violated my privacy. By the way, your accountant has some real problems here. If you wished to press the issue, that mistake of allowing someone's personal information, even though that you're in close proximity, he or she should have known that you keep your finances separate. To share someone's all of her information to somebody that should not be seeing it, yeah, the accountant made a huge error. And if it were me, I'd be having a serious conversation or worse with the accountant. But in this case, you say we're both committed, but we're not interested in being married. I think that kind of sets the stage for what has happened here. You're right. You thought you were both committed. You're not. She's not. She's certainly not committed to honesty or trust or any of that kind of good stuff. And for anyone who has had a a successful long-term relationship, trust is the key. Trust is everything. So your first suggestion, I think maybe I'll move out, get my own place, and keep my own money separate. Sounds like you want to continue that relationship. I can almost guarantee you, not, please, not psychotic, sure, not psychic. Almost guarantee you, this relationship does not have longevity in its future. So big breath, own place, separate and goodbye, and start fresh. Start fresh. Not exactly Dr. Phil. I don't think he was that snarky, but maybe. Bless. I told you, I tell you every week, we get some of the most fascinating questions, and some of them seem to be financial, and they're really not. Megs, maybe the next one is financial?
I think so, and I think that was minimal snarkage. This one says, Jean, I love your show. My son has $10,000 to invest for his 2 children, ages 5 and 9. He doesn't want a 529, so what would be a good alternative? Thank you.
A good alternative to a 529 would be a 529. I say that only slightly sarcastic. I mean that to catch everybody's attention, but I want you to hear that the 529 plan is so useful, has so many positives, so many good long-term applications, that in order for, if this gentleman's son were to come to me saying, here's 10 grand, don't put it in a 529 plan, I would say, all right, let's stop right there. Tell me why. Tell me why you think it should not go into a 529 plan. Now, one of the answers that we might get, a 529 plan is for college education, and I don't want my kids to be forced into spending this for college. I hear you, but a 529 plan is not just for college education. Oh, well, maybe this is money that I want to have put away for their long-term financial security. Recently, the 529 plan rules changed so that if a child is not going to use it for education, the parent can direct that money into a Roth IRA for that child. Pretty powerful stuff. So if it's not education, it could absolutely be for retirement. And it allows, the 529 plan rules allow that if the parent at some point decides that the children have kind of gone off the rails, this particular child doesn't deserve the money, I don't wish to give it to them, they can take it back. They can take it back. So there's tons of flexibility. Now, I will give you one answer that would absolutely shut me up. Bottom line is, hey, I don't want a 529 because I already have a 529 and I've put a lot of money into it. So that as I look at my kids, I know that they're going to have plenty of capital to get educated however they wish to be educated. And just as a reminder, folks say, well, it's for college. 529 plans provide for tax-free earnings to pay for, yes, a traditional 4-year college or a 2-year degree at a community college. And if you haven't checked out community colleges lately, they are unbelievably impressive. The breadth of their offerings are dynamic. The ability to go in, grab a degree, grab a certificate, grab some education, and go out and immediately put it to work is impressive. Oh, by the way, you want to go to culinary school, that would be covered. You want to go to a carpentry apprenticeship program, that would be covered. Education is a very broad topic as far as 529s go. And by the way, it's not just for college age anymore. There was a time it was. You had to be 18 or older, you had to be out of high school. Now it can be used legally for preschool right on through. And just for fun, let's say you're a little more senior, but you're in a position or you're in a profession that requires you to have continuing ed. You can use 529s for your own continuing ed. Some states, Pennsylvania is a good example, gives you a deduction on your state return for putting money into a 529. So if you know you're in a profession, let's say you're 35, you're going to be in the profession another 30 or 40 years, and you're going to have to spend $5,000 or $10,000 a year on continuing ed, you might set up your own 529 plan for yourself. Now, having said all of that, if indeed this gentleman already has 529s for his children, and they're all squared away in this $5,000 or $10,000, $5 apiece is to be used for different purposes, I would encourage an investment account. You can do it online independently. You can do it through a financial advisor. I would encourage them to use stocks, either stocks or stock funds, exchange traded funds, because they tend to grow without a lot of taxation. And when they are taxed, it tends to be capital gains. And for young folks with modest incomes, the capital gains is likely to be zero. So let's pick, I'm picking out of thin air, Apple stock, we put the money in, and many years later it's sold, and they're still students. Their gains will be likely taxed at zero. It's a pretty effective way. You want to avoid CDs, you want to avoid bonds, you want to avoid those kinds of investments that create taxable income, because that ends up eroding away at the profits. And since these are young folks, 5 and 9, they've got plenty of time for a good basket, $5,000. You could invest in a number of stocks. And there are a number of ways to do it very efficiently and very cost efficiently, and yet end up paying either nothing or nearly nothing. So either way, but you'd have to convince me 529 isn't appropriate. Megs, who has to convince me next?
Well, we have an estate planning question. This one says, we are looking to do estate planning. We already are with a financial planner, but are not sure if we're on the right track. We are also wondering if the fees being charged are reasonable. I have a 401k with my employer. I also have a traditional IRA, Roth, and savings with an advisor. My wife has several accounts on her own that are self-managed. We enjoy watching the show on PBS. The positive attitude that I get from watching the show is recommendation enough for me. Thank you.
Oh goodness, that's one of the nicest compliments that I've ever heard. That's fantastic. And we are optimistic. We're not just a glass half full kind of folks. We're glass pouring over the top, overflowing. It is. We're very blessed. We're very blessed. And it sounds like so are you. You've got a couple different questions here, and it's actually quite interesting. Talking about having a financial advisor for a piece of your puzzle, and then for a piece of it, you're in the 401k. It does not sound like your financial advisor is involved there. You're wondering about whether self-managed versus advisor versus 401k, how those kind of all fit. The estate planning piece is what you lead with is almost sounds like it's gotten lost in the shuffle. Most quality financial advisors, and I emphasize quality because as much as our profession has a tremendous number of high quality, tremendously dedicated financial advisors, there are some bobos, and you'll bump into some firms where you can almost immediately identify they're not high quality. If, for example, you ask a question about estate planning and they say, oh, we don't do that, you just check with your attorney. Yeah, they're probably not that high quality. If you ask a question about income taxes and they say, oh, we can't answer income tax questions, we're not allowed to, you have to check with your tax advisor, yeah, they're probably not very much in the way of high quality. If you ask questions about Social Security, 401ks, IRAs, taxes, all of those brought together and they go, we can't really answer those questions, we are just helping you with your investments, it's probably not a high quality firm. Now, if any of those things apply to your current advisor, and you're paying anything between, on the very low side, say 0.75% per year, if it's a very large investment account, to maybe 1.5, 1.6 if it's a relatively smaller account. If you're paying those numbers and you're getting these limited services, you're paying too much. That's pretty straightforward. Because you could go to a very high quality firm with very well-trained professionals that can give you investment, estate, tax, insurance, Social Security, Medicare, all those kinds of counsel, same cost. So if indeed you're paying within that range and you're getting rather limited services, you're paying too much. Now, let's talk about the self-managed, advisor-managed, and 401k. Again, if you're with a quality financial advisor, they will be able to demonstrate to you that their services are so advantageous, is a good word, to you, that you really want them to be managing everything. If you're unsure, or if, let's use the extreme example, we're looking at all three of these kind of buckets, the do-it-yourself, the advisor, and the 401k, and you find out, gosh, I'm doing better on my own. The question might come up, is it you're doing better because you're taking a lot more risk? Are we comparing apples to apples? Or is it legitimately, I'm doing basically the same thing and I'm just doing better? Then the advisor kind of falls off the plate. The 401ks typically are fairly limited in terms of their investment options, but that doesn't mean they can't be very, very efficient and very effective. In many cases, their fees are quite low, and if your menu is very dynamic and fits you, you might benefit by moving IRAs into the 401k, leaving the advisor behind. Now, let's assume, just for fun, that you find out that your fees are reasonable, the advisor's doing a good job, better than you are on your own, and better than the 401k. Now it's time for you to make a choice and bring those funds together to under one roof, so to speak, so that you can get the advantage of high quality advice. But again, if it's not including all the ancillary services that I outlined, sadly, you are probably paying too much. Most quality financial advisors, gosh, most as in basically everyone that I'm familiar with, would welcome the opportunity to sit with you and compare what you have with what they offer at no charge. That meeting, often referred to as a second opinion meeting. There's no cost involved, there's no obligation. If they're quality advisors, there's no pressure involved. In essence, it's a job interview. You're interviewing them to see how they compare to what you currently have. If you interviewed 2 or 3, I think you would learn a lot, and either you would come away knowing we have to move, or you would come away appreciating what you currently have. Either result would be great. Speaking of great results, is there a question back there that I can provide great results to?
I'm pretty confident you can. This one says, I recently sold the family home that my parents purchased in 1960 for $10,000. My parents gave the house to my sister and me in 1981 for no money. Prior to that, they did considerable capital improvements like a large addition, new windows, had a basement dug, built a garage, and more. My question is how to value those improvements without any receipts. Most of the work was done in the early 1970s. Thank you for your advice. We sold the home for $375,000 in January of 2024, and we hope we can reduce our taxes. Thanks.
Okay, this is a remarkably common question. Remarkably common. There's a wrinkle here. There's a wrinkle here. And the wrinkle is that the parents gave, I'm going to assume these are two sisters, that gave the sisters the home 43 years ago. So there's a line of demarcation between prior, 20 plus years prior, and the 40 years since. When the parents gave them the home, they also gave them their cost basis. So when this young lady says they bought it for 10, that's where you start. There may have been some expenses in the purchase. Let's say there was $1,000 in legal fees, et cetera. That gets added. And then the cost of any major improvements, not maintenance, paint and paper does not count, but a new roof, new heating system, new porch, an extension, an addition, all those things, they are added to the basis. How does she know? And the answer is she doesn't have documentation, but by counseling with particularly a contracting firm that's been around a long time, would have done some work many, many years ago, she can get a sense of what they paid. In addition, they paid $5,000. Today it would be $75,000. Back then it was $5,000. Adding all that up will increase her basis, their basis, up to the 1981 when they took it over. And let's just, for the sake of argument, say it's $30,000. They sold it for $375,000. Excuse me. In the 43 years since, if they've done capital improvements, it sounds like they might have, $10,000 to $375,000, those add to the $30,000 cost basis they started with. So a new roof, heating system, et cetera, et cetera, et cetera, all that gets added to, and any costs that they have in terms of the sale, whether it's a sales commission, they can be very expensive, could be as much as $20,000 on a home this size, transfer taxes, et cetera, those reduce the profit as well. So a little bit of work, a little bit of estimating is necessary. We don't have the documentation. The IRS understands that. Reasonable numbers will get you a reasonable result. And it's a shame you don't have more paper, but the reality is you'll probably end up doing pretty darn well. Megs, do we have maybe one more back there?
We do, and it's a short and sweet one. This one just asks, what is the difference between a Roth contribution and a Roth conversion? Thanks.
Do we have a long? No, I'm kidding. That is a short one, goodness. Convert versus contribution. Lots of people mix this up. Lots of folks really struggle with, am I allowed to do one or the other? Lots of folks are not clear what the differences are. So let's start with basic definitions. A contribution to a Roth IRA is what you're allowed to put into your account based on your work history. So currently, if you're 50 and under, it might be $7,000. If you're over 50, it might be $8,000. But it's based on the fact that you have earned income, either in self-employment income, you're an employee, etc. So if you want to put in the maximum that you're allowed to contribute on an annual basis, you look at your earned income, and you can put 100% of your earned income up to a limit of $7,000 or $8,000. So bottom line is, hey, I made $25,000. I'd like to contribute to a Roth IRA. You can put up to $7,000 or $8,000 in. That's an annual contribution. Conversion says something very, very different. Conversion says, I've been putting money into an IRA or a 401k or a 403b or other retirement plan forever. And now as I've gotten older, I've got a rather large sum of money in my traditional standard IRA 401k. And goodness, I would like to take advantage of the Roth IRA. Can I do that? The answer is yes. The IRS has created a system where you can convert, meaning you can take a chunk of your current IRA and move it to a Roth. It doesn't require you to be working. Lots and lots of folks who do this are retired. They have no earned income. There's no requirement that you be working. There is a requirement, however, are you sitting down, that you must pay income taxes on whatever amount you convert. So let's say that you have $200,000 in an IRA and you want to convert $30,000 into a Roth. You will pay tax on the $30,000. Once it hits the Roth, you will pay no more income taxes for as long as you live, according to the IRS. Is it a good idea? Because the taxes might be very high. Is it a good idea? Because the taxes could be, in many cases, people are surprised how low the taxes are. Pay a few dollars now to get it out forever. It's an assessment, an evaluation that you've got to do with a trained professional, either a tax professional, enrolled agent, CPA, etc., or a financial advisor who's comfortable with taxes, a quality financial advisor that can discuss those tax issues with you. So contribution means I'm working and I'm putting money away for my future. Conversion means I have been working for years and I want to get from taxable to tax-free. Gosh, I hope I helped that a little bit. It's a challenge. Speaking of a challenge, it's always a challenge to make sure that we're bringing you the very, very best that we can. And Megan and I think we're up to the challenge. We do that every single week for you. So whether your questions are about retirement, investments, Social Security, Medicare, estate planning, ownership of real estate, Roth conversions, or Roth contributions, these are all fair game and so much more. Your questions are far more interesting than anything I might come up with. So please allow us to serve you. Send us your emails, gene@askmtm.com. We promise we'll answer you directly, and maybe you'll see your question on a future edition of More Than Money. Speaking of future, hopefully you've learned enough tonight that you'll want to return next week when we're back behind this podium to answer more of your questions on another edition of More Than Money.